Master your money, free your future. Welcome to Budget for Life. My name's Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. In this video, I want to start solving for GameStop's Q1 margins using what we know at a granular level from their 2017 and 2018 margins, which if you've been following along with some of my older videos, okay, you can look through their historical 10Ks to learn a lot about smaller portions of their businesses. So we're going to use that historical knowledge. We're going to combine it with their historical margins. And then we're going to think about fundamentally what has changed from 2015, or sorry, from 2025 back to 2017, 2018, using what we know about their total margins, right? Their total revenue numbers broken down between hardware, software, collectibles, as well as their total gross margin. Can we put the pieces together to have a better understanding of what their business lines are right now and what the margins are across those different lines? And if we can, that means we will also be able to know then in Q2, how does the Switch 2's introduction then affect their business lines? And then incredibly importantly in Q3, how do digital power packs affect their top line and what kind of margins is GameStop receiving on the digital power packs? So understand this is honestly a very clutch period to look into because we in Q1 basically we can just distill down different portions of their business in an important way. So Q1 is the very, very end of the console cycle, right? Pre-Switch 2. And it's also, as far as the collectibles business goes, a major difference from Q1 in 2025 from Q1 in 2024 is that GameStop was now doing card grading, right? Their partnership with PSA to grade your cards and also to sell graded cards on GameStop's website. So we can actually learn a lot about what are the numbers within that business compared to the legacy collectibles business. And then we get a separate quarter where we can then distill down what is the impact of Switch 2, and then a separate quarter of what is the impact of digital power packs to be able to break these out separately rather than all of these changes happening in the same quarter, right? If they started grading in the same quarter that the Switch 2 came out, in the same quarter that digital power packs came out, we would actually have an incredibly difficult time solving for what are the numbers of these different business lines. But because GameStop has staged it, staggered it by quarter, they actually are giving the opportunity for analysts like me, right, to actually understand at a more clear level if you want to do the work, right, which we've been putting in the work over here, can you understand at a more granular level what their margins are doing? And I'm excited to dive into it. Before I dive into it, just want to say thank you to those who have subscribed to the channel. We're on a march to 2525, and we're getting pretty close. I'm calling it the Halo Sub Club. Everyone, let's say one day more people in the universe know this channel exists and there are more subscribers than there are now. It's kind of fun to have some clout to be like, oh, I subscribed back when they were only at blank, back when Budget for Life was only at 2,500. But what I'm doing with these sub clubs is like basically just titling windows of subscribers. So one day you could be like, "Oh, I'm a Y2K subscriber." It's like, "Oh, dang, you were there since it was less than 2,000." Oh, I'm a part of the Halo sub club. Oh, dang, you were there before it was 2525. And I'll let you know what the next one is here soon. Anyways, also thank you to the fans and friends of the channel. I do appreciate the support. All the earnings of the channel go to DRS Book GME shares. It's my way to align the interests of the channel with the interests of the viewers, with the interests of the company. If we can have aligned interests, I think we can do we can have a greater impact than without aligned interests. So I do hope y'all appreciate it. Um, so let's look at 2017 and 2018 and then think about now. So This, again, GameStop has not reported these numbers at this granular of a level. These are numbers that we have solved for with the work that we've been doing on the channel. Um, but if you were to take basically the percentages and think about the current business, like what do we know the most about the current business? Probably collectibles is the easiest place to start because we have the full collectibles business numbers, right? In Q1, we know that collectibles earned $211 million. So we just basically have to decide how much of that is legacy and how much of that is grading, right? We know that they didn't do any digital power pack sales in Q1. So we don't have to worry about that. But we do want to think about what are the sales numbers from their legacy collectibles business? What are the margins? And then what are they getting on PSA grading and marketplace? And what are the margins? So with the legacy, we really want to think about what's the difference in revenue from Q1 of 2025 to Q1 of 2024. And in 2024, their 15% of 881 was a $137 million quarter for collectibles. Now, their total sales are actually down Q1 to Q1, and their store count is down Q1 to Q1, right? At this point, GameStop had close to 4,000 stores, right? Compared to now closer to 2,500 stores. So the odds that the legacy collectibles business is doing the same amount of money year over year when the top line is down and the store count is 40% lower, that's a very low odds that that's the case, right? It's much more likely that the legacy collectibles business, it actually shrank somewhat proportionally to GameStop's store count reduction, but not as dramatic as a store count reduction, right? Because we see the top, stores cut 40% and sales were only down, what's 150 over 881? 150. Sales were down 17% year over year compared to 40% store count reduction. So if we were to apply that sales reduction evenly, we could say that the legacy collectibles business probably shrank about 17%. Obviously, that's not a firm number, and it might be even a little bit more than that. But we know that software um, dropped sharper than that, right? Software dropped 27% year over year, and hardware dropped 32% year over year. So a lot of the dollar reduction, that's actually really interesting. 881. So the legacy, basically the question is how much of this 211 is legacy collectibles? How much of the 211 is actually PSA grading and the PSA marketplace? When I say PSA marketplace, I think you guys know I am talking about cards that you can buy at GameStop directly, right? So separate from their Power Packs business, but you can include their physical Power Packs with this PSA card grading slash marketplace lump. If the dollars decline in software is about 65 million, and the dollars decline in hardware is about 160 million. I mean, man, you're looking at like the odds that the legacy collectibles did not shrink at all when software and hardware both shrank dramatically is low. But I also think hardware and software shrinking more dramatically than collectibles is probably accurate because of the console cycle, right? As you get closer and closer to the end of the console cycle, hypothetically, fewer and fewer consoles and video games are being sold. So you would think that those businesses would be a little bit more susceptible, but neither shrank as sharply as the store count, right? So they still successfully consolidated their business in a way that increased efficiency, either drove more customers per store or drove more customers to be online customers. So I think, I don't know, a 17% might be might be too, like maybe it's closer to 20, but ultimately we're talking about a small, if once we're in that type of range, we know that we're at a high level of accuracy, right? If we're trying to debate, did the legacy collectibles business decline 17% or 20%? I'm going to go with 20. So 136.68 turns into 109.34 for Q1. And let's see how it all ends up shaking out. 109.34 is the dollar amount. Take this and divide it by the 211 number. And then this would be that 211 number minus the legacy, right? Wow, that is dramatic. That is a powerful, powerful number. Um, in PSA grading and marketplace, I think this has totally gone under discussed, right? Because we see the total collectible sales, right, at 211, 227. We're like, man, this looks like the grading is going to be pretty modest, right? I don't know how many people are actually buying cards from GameStop. But then you look at the like because the top line was still declining year over year, it was easy to feel like the grading was not that impactful. But we're effectively like we're talking about something that was actually growing quite quickly in the midst of the legacy businesses continuing to consolidate. I mean, 100 million in a quarter is just amazing. So, what are the margins, right? Obviously, we don't know, but historically, the legacy collectibles business in 2017 was 32.7. It was 33% in 2018. Um, and the odds that it's dramatically different than that, I'd say, are pretty low. We do know, as far as what's changed 2025 since, like from now since then, we know that GameStop's overall gross margins have improved. So is it likely that they were able to squeak out any more margin through their cost reduction efforts over the years, right? Have they been able to sell collectibles any more efficiently, right? You see total gross margins all the way up to 34% compared to the year before 29, 25, 23, 22, right? So you would imagine that the margins that they're getting across the board are all for whatever they can control. You would think they are a little bit better now than they were then. Now, new hardware, new software, I'm not really sure how much GameStop can really control the margins that they're getting on that. Collectibles, I could see how there might be more wiggle room for GameStop to improve. Let's let's say that they've improved this to a 35%. And we'll see how it all shakes out. Because again, once you start adding margins, we're going to get to see, okay, what are the total gross profits and does it reflect what we know GameStop's total gross profit and margins really were? Oh, sorry. I put that in the wrong spot. 35% for legacy. I think the PSA grading and marketplace is probably closer to 45%. So in past videos, I have, um, or at least in one past video, I started looking up cards, like what is GameStop selling a card for online, and what are they willing to buy that same card back for? Obviously, there's some discrepancy whether you are a pro or not, but basically, worst case, they're running at like 39%, and best case, it gets all the way up to like 60% on the spread, depending on if the person selling to them is a pro or not, and then if the person buying from them is a pro or not. So I anticipate that they're grading. So the marketplace is somewhere in that, 45, 50% range. The grading, I think probably a lot of that revenue is going to PSA because PSA is the one doing the grading. I think GameStop is receiving a small fee, a small commission for being the distribution arm for PSA's grading services. All that to say, I think that the revenue that they're getting from grading is a high margin revenue, but a relatively low total dollar amount revenue. I think the majority of their revenue um, is coming from their card sales, and probably there's probably an insane amount of grading volume that like the revenue that PSA is getting is probably much higher than the revenue that GameStop is getting from their uh, from their grading. So there you go. You've got $84 million of gross profit coming from collectibles in Q1. Now, when you think about hardware and software, so what we're doing right now is we are making the best guesses we can on the sales numbers and margin numbers. And then we're going to get to see, do those best guesses line up with reality? Because this, if our guesses are perfect, then this number that currently says 84 will say 252. This number that says 33% will be 100%. This gross margin number that says 11.51% will say 34.52%. So we'll make our best guesses based on what was, what's changed, right? And what is right now. And then we'll be able to kind of fill in the cracks with, okay, so what are we high on? What are we low on? And let's kind of tweak our assumptions. I think as it relates to software, I think the digital sales is probably what we know the most confidently. And the reason I say that is because obviously the transition of software sales is going from physical to digital, but also GameStop's historical digital sales are much more stable. So you saw from a margin perspective and a sales perspective. So 2017 to 2018, 189, 194. Right? Compare that to their used business, 1250 one year, 950 the next year, right? Huge volatility. And yet their digital sales incredibly stable. Now, when you think about historically, right, all the way back to 2012, digital is it's 208, 218, 216, 189, 181, 189, 194. Right? A very steady business. And even from 2018 to 2012, right, that is a six, about a $15 million decline over that 6 year period, which is a 7% decline. Now, the percentage of games that are sold digital is higher now than it was in 2018, but is GameStop able to compete equivalently, or are they still losing? Like, are they losing digital market share faster than the digital market sales, the digital market size is growing? In other words, are a higher portion of digital game purchases happening from digital marketplaces that GameStop does not overlap with, right? Are more people doing it directly from the console than via GameStop? Probably so. And if you're not familiar, like when you buy a game from GameStop, I'm just picking a random game, like they make it very simple on their website. Do you want the digital version, a physical new version, or a physical pre-owned version? Like super simple. So the like GameStop is definitely still selling digital games. There's no doubt about it. Um, but when you combine their position primarily as a physical retailer with overall, we know that software sales are declining, right? Software is 175 this quarter in total, compared to um, in the past years where they were doing, a billion a quarter, basically. Like it's much smaller. And I think digital is probably a portion of that, but the lowest portion of the decline. If we were to say that they've declined 7% since 2018, right? Another 6 years later, another 7% decline, then we would have digital, a full year digital software sales at 180. And if you just basically, I mean, dividing that by four would be a little bit lazy because you know that the weight of software sales is heavier in Q3 and Q4 from holiday spending, right? But if you were to say, hey, maybe full year is 180, and then what percentage of that do you think happened in Q1? Maybe 20% of it. So maybe there's 36 million of this 175 that's digital. Um, oh, 334 divided by this number up here. You did not. You did not. Oops. Okay, last attempt. Sorry, guys. And what type of margin would they be getting on digital? I think there's no reason to think it's dramatically different, right? From 86% in 2017, 88% in 2019. Right, back in the day, it was lower, 58, then 68, then 70, then 79, then 86, then 86, then 89. Right? It seems like margins are continuing to grow, but how much higher can you really get than 89? I don't know. So I'm going to say they cap out at 89%. There you go. Some digital margins, some digital revenue. Now let's look at PC new and used. Man, should we dive into it? Should we dive into it? It's hard. Man, what do we know? What do we know? Right. Um, okay, let's think. Let's think. PC software as a percentage of their software sales in 2017, PC. Well, I actually want to cut out digital, right? If you were to take PC as a percentage of new, used, and PC, you get that it was 5% in 2017, 7% in 2018. I think that what's changed from 2017 and 18 to now, I think the used business is probably lower now than it was then. The reason I think that is because that is the trend that we uncovered in this video. Software is declining, but basically PC and new are declining at the same rate, whereas used was declining at an even faster rate. 299. Okay. So there's the new software versus used software versus PC software. Also important to mention that in 2017 and 18, the Switch had just come out, the original Switch. So when you think about Q1 of 2025, um, important to think about how the new software might be relatively lower than the used. Right, you see in 2018, used comes down and new goes up. This is most likely as a relation to consoles, right? Okay, something. So if we were to go with numbers more similar to this, but slightly less for used, right? Is the used business for the amount of revenue we have left to account for, which is basically this 175 minus the 36 that we're talking about. We've got $140 million left to distribute between new software, used software, PC software. Used seems to creep up into a slightly higher percentage of the pie when you're in late stage, right? Even if you think about 2016, this used line is higher than in 2017, but part of that's just the overall decline. So it's hard to parse out how much of that is console cycle, how much of that is the declining software business as a whole. Let's just punch some numbers in and we will see where we end up. The Man, you just have to pick a number at the end of the day. Obviously, we know that this total software business has plummeted. I think this used portion's probably continued to come down. I think it probably has. So if we say that the used software is now only 20% of the new slash used slash PC pie, it used to be 31, then it was 25. Perhaps it's even lower now, right? Maybe this 31 is not related to the console cycle, but more related to, hey, just continued year-over-year declines, declining faster within the used section than they are in the new section. If we say 20% of the remaining software sales is used software, then we give it a margin. So they were at 57%. Oh, right, basically both years. I'm going to assume that their margins there have remained relatively unchanged. I'm going to say they maybe even came down slightly Perhaps GameStop is wanting to be slightly more fair with their trade-in. I don't know. I'm just going to stick with the 57 since we spent a long time solving for that. Let's say 57% margin on the used. Okay, so that's 20% of this number, which means we have 80% left to go. In both of these, the PC is about 1/11th of the new. So if we take, oops, where am I? Here we go. If we take this number, now we take out the 27.96. We take that number, divide it by 11. Maybe that's about where the PC number would be. And then this new would be the total minus these below it. Sum of, geez, that can't be right. What's going on here? What is going on here? Oh, I did the wrong, that'll help. Okay, this is looking maybe better. New versus used might not be that dramatic, so we'll come back to it. Margins on PC, somewhere around that 32, right, for a new PC game. For a new video game, right, somewhere in that 22 type of range. And we are at, so far, 155, and we need to get to 252. Let's see how we're looking when we dive into hardware. Woo! Y'all learn anything yet? You thinking about this critically? These assumptions are actually so important. That's why I'm going through this video slow. It's not to tire you to death, okay? It's to help you think about it because this is going to be the framework that we then take our educated guesses for the margins on and revenue on the PSA grading, on the digital power packs, um, and the new Switch 2. And those numbers matter so much, just so much. Okay, hardware. We know the total number is 345. What do we know the most? Maybe, what do we know the most? We know that electronics is small. I mean, real small. So we might just save that for last. We know that it's late stage, right? I put down here the percentage of new hardware sales is lower later in the console cycle than sooner, right? It was 47% of the hardware line in 2016. I think that's probably a good place to start. Late stage, new consoles, 47% of the hardware pie. And we know the total hardware pie. And let's do this whole percent of sales thing. Oh, 326 divided by M, 320. Now, where does that leave us for the rest of the business? Well, we also know that historically, the hardware business, right, about 24% of it is pre-owned hardware. right? We solved for that, kind of regardless of where you are in the stage. So if you take that 24%, maybe 24.5 times the total hardware number, that's where you're at there. The accessories business, historically, let's see. In 2017, the accessories portion of the pie equals S 297 divided by T 295. Accessories was 22% of hardware sales in 2017, 26% of hardware sales in 2018. Man, that is interesting. Margins very similar. Wow. I think the percentage dedicated to accessories is probably higher now than it was then, partially because electronics, we know, well, was on a very clear multi-year decline. But also GameStop has introduced CandyCon since then, like their private label accessories. And accessories are higher margin. So obviously GameStop is incentivized to sell more of them to help their overall hardware margins. But how much percentage is left, right? We have 28% left. And if we basically put 27 in accessories and then 1% in electronics, I wonder what that ends up looking like. 28 times this M320 number, and then 1% for electronics. Let's see if it ends up adding up well with our margins. 346. Why is this higher? Honestly, 129. Oh, because the 245. Gosh darn it. Just call it 24. There we go. Okay, so margins. Margins on new consoles. Late stage, before the Switch 2 finally comes out. I mean, historically, like new hardware, 7, 10, 10, 9, 11, 9, 8.5. This is the Switch 2, right? Taking you down from 11 down to 9 and 8. If we say that before the Switch 2 came out, maybe they were getting 10% margins on new, used margins we solved for recently. Margins from used hardware, about a 29% margin. We'll call it 28. Maybe they have slightly come down. Accessories margins, I think, have probably come up relatively meaningfully due to private label. Let's call this, let's see what it looks like at a 38% instead of a 32.7. That might be too aggressive. We'll see. And then this tiny sliver of electronic sales, probably still around that 26% number. So, where does that put us? Low. It puts us low. So, obviously we know the total numbers are accurate, right? But if my assumptions about their margins and which lines are what portion of revenue, um, That's where the discrepancy comes. We're 92% of the way there just using historical assumptions. Now, when you look at the present day um, versus this breakdown, we know that in some combination of ways, the margins GameStop getting is better, or the revenue that they're making is higher in some of their high margin businesses. Now, margins, like, are any of these margins meaningfully different than what I described? Could the legacy be at 36 or 37? Sure. Could grading a marketplace be at 46 or 47? Sure. But there's nothing is way off on the margins. We actually have a lot more clarity on their margin numbers than anything else. What we have less on, of course, is what type of margins is accessories getting. And by that, you really mean like how many private label accessories is GameStop selling? Because hypothetically, GameStop's getting 50% margins on their CandyCon sales. So how much of those sales represent the total accessories? I did already give them a large bump, right? A 5.5% um, improvement, which is really more like a 20 something percent margin improvement on their accessories line due to CandyCon. So again, could that be 39%? Sure. But I think more likely there's some higher margin businesses that we attributed too low of a sales figure to. On the hardware side, the new versus used, two new for every one used. That's one assumption we could look at. And I wonder if, right, is there a way to, I mean, we already kind of distilled that down because it's really more than 2 to 1 post console cycle. But is it possible that this is actually slightly higher than 24% before? Like that's basically what it comes down to is the used software and used console in light of the fact that this is towards the very last quarter of the console cycle. Does that inflate some of these numbers? Because again, up here, we're looking at full year numbers, whereas right here, we're looking at just quarter one. And so you would expect that within the literal very last quarter, that you're going to see some larger swings within their business lines. The other thing is digital, right? We assumed that digital came down to 180, but because this is a high margin business, right? The more that we undersold digital, right, that has a huge impact, right? If the annual sales for digital are actually higher than 180, and if the percentage of digital that happens in Q1 is higher than 20%, then that makes a huge difference, right? Because almost every single one of these dollars hits down the gross profit uh, dollar figure. And right now we need about $20 million of gross profit. It's probably a combination of all three, right? Maybe digital is actually still doing 190, right? And so if you say that 20% of that happens in Q1, there's a couple dollars there, right? Not a huge needle mover. The legacy collectibles could have shrunk even sharper than 20% year over year, right? Remember that whole assumption? How much of this 211 is legacy versus PSA? We did see, again, both hardware and software decline sharper. So is it possible that the grading and marketplace is already larger than the legacy collectibles business? It's possible. I think this breakdown of new versus used is the most glaring uh probable inaccuracy, right? Historically, I mean, and we felt that way even putting it in, right? But the question is just how much faster is used declining? So what percentage of the software business is pre-owned? In 2018, it was 25%. In 2017, it was 29% of the total software business. If you take out digital, then 26% and 30%. Down here, we have it falling all the way to 17. Um, well, if I want to include PC, 335. Then I really have it all the way down to 15%, right? Oh, that didn't make sense. So this number is almost definitely higher, right? If we call it 3, right? Let's say it fell to 24, which it still could be higher than that, but what does that do to gross profit? Okay, it's still down to 238. So let's say that the used and new continued to decline at the same rate, and that used actually does a little bit better um, into the late stage than once brand new consoles come out, which then inflates the demand for new games, right? This 19% number, um, or 24% if you net out the digital sales, which digital is as a percentage of revenue is growing. We know that digital is not, I mean, we don't know for sure, but we basically know when you think about their margins that digital as a percentage of revenue is growing, that it's more stable than the physical software business. But right now, we basically have 3 new software sales for every 1 used. And I just wonder, like used, it was 2 to 1 in 2018 and less than 2 to 1 in 2017. Has it escalated all the way to 3 to 1? Based on their margins, you would think, like based on their total gross margins, you would think it probably hasn't escalated all the way to 3 to 1, right? Maybe it's more like 2.5 to 1. And on a full year basis, but on a quarter, the specific quarter basis, right, where you're in the very late stage of a cycle, maybe it compresses a little bit more and then re-expands. Obviously, as you think about Q2, I think this is getting pretty accurate on their used. Again, it could just be slightly more, but obviously we're in the ballpark. Used consoles 2 to 1. Again, similarly, we've already we've already distilled down their console sales, their new sales a bit. But used hardware, oh, this was their whole pre-owned business. Oh, so let me go back to their total software. Yeah, it really was more like, total software netting out PC and digital. It went from 32, right? So like three, you know, $3 of used software for every uh seven of new, $28 for every 72 of new. And again, that expanding, like that furthering of the gap, probably exacerbated by the new console cycle. With hardware, one used sale for every two new sales in 2017 and 2018, but likely a little bit more compressed pre console cycle, right? So this at a 2 to 1 is probably a little bit, um, probably a little bit more compressed if we think about right before the console cycle. Right now, it's more like 1.5 to 1. This used to new, I think is still. I think this is too aggressive. Like I don't think it compressed this far. Too like I think this is probably closer to accurate on the revenue side from the new to used split. But what does that mean? Man, it could obviously accessories margins on the new could have been higher and on the used for that matter. Like if they just improve their margins a bit from their historical averages, right? Squeaking out some more margins on their sales. If legacy is improved closer to 37, if PSA grading is more like a 47, PC gets a 1% bump, right? Just a 1% bump across the board. Then we're really, really in the ballpark of likely what their margins looked like in Q1. Right? We're 98.75% of the way there. If I were to guess from here, what's the main difference, right? We've done a little bit of margin bump across the board. We've said, okay, use is probably still a slightly higher portion of the pie. It's possible that legacy actually came down a little bit more than this, right? You take a couple dollars off of legacy and move it into grading. And it's possible also that digital is actually a little bit higher than this, and or that PC is is somewhat higher, but I think PC is probably like PC and electronics are obviously not huge needle movers. All right, is it possible that digital's actually even grown a little bit? Certainly it's possible. Their website's better now than it was back then, right? When you think about their digital sales historically, how much of those sales happened from the stores, you know, compared to their website now, how easy it is to buy a digital game. And we know that the gaming industry is larger now than it was then by 2x, right? So I think that's probably the discrepancy is maybe their digital inverted actually even back to 2016, right? They went from 208 grew a little bit, right? 217, then 16, 188, 181. But then sequentially, right, grew 8 million year over year, 17 from 16, grew another 5 million year over year, 18 to 17. And so perhaps the digital is actually not lower than it was in 2018. Maybe it's actually back at like a 205 type of number, right? And if that's the case, then we're all over it at this point. Right now you can just tweak whatever you wanted to make up that last little 0.49%. Um, and what's the most likely tweak? What's the most likely tweak? Okay, so this should be at a 9.7 now because that came down. If it's 1/11th of the remaining pie. Oh, but the remaining pie, what is that? 27.96. I think that's supposed to be the used number. Nope, don't do that. 37.39. I shouldn't have two things referencing the same cell. Okay, what's the little tweak we want to do? I think accessories as a higher portion of sales is probably the last tweak that makes the most sense that we haven't really challenged yet. I think the margins on accessories are generous enough, maybe even slightly high, but the portion of total consoles that's accessories, particularly again late stage, very, very late stage, the last quarter, right? We have it higher, right? It was 26% in 2018. I mean, if you go down to like 2016, this is accessories, right? Um, what is the accessories number? AE288? Yeah, it's 23%. So it's growing. What is that growing each year? Yeah, I mean, accessories growing as a portion of their business is a clear trend. Maybe something that usurps console cycles, a very clear business strategy, saying, "Hey, we want more and more of our revenue to come from accessories, particularly before the console cycle comes out." Let's say it got all the way to 32%, right? If it did, then all of a sudden we're over, right? And if it's actually 38% margins, oh, and we're over 104, of course. So if it's at 32, then what comes down, right? This comes, where are we at now? I need to get smarter, guys. 43, 33. Boom. Okay, that's at 100. Man, we're all over it now. We're all over it. I think 32 maybe is a little rich, maybe 31. Maybe feel like this needs to come down to match. Right, we want this somewhere around a 2 to 1, slightly skewed towards used. I'm really liking this, guys. Mm. Then if we go back to the 39 on the margin, then we're right there. And then we can just basically add a tiny bit of margin to their hardware to kind of make up the gap. I'm liking this a lot. Six one, 6.5. Oops. 2.77. 2.78. Oh yeah, we all over it now, dog. We all over it now. There you go. There you freaking go. All right. My best guess for Q1 sales, right? This is what we know. These are known numbers. My best guess of the breakdown right here. Hardware, software, collectibles, new, used, accessories, electronics, new, used, digital PC, legacy collectibles, PSA grading, digital power packs. Here's how they represent the sales within each figure. You add those up, you get the same numbers, right? 345, 17.8, 175.8, 211.7. Our best guess at margins, right? Again, all these plus or minus a few million here or there, right? You can mix and match however you want, but this is a high level of clarity, guys. This is gangster stuff right here. So then you get your total gross profit numbers. Look at how evenly spread their profits are despite the sales percentages, right? So the margins overall in their hardware, software, and collectibles business. Did you expect that their software business is actually their highest margin business, higher than their collectibles business? That is the case because digital is an increasing size weight within their software sales, but obviously the collectibles profits are higher than the software profits and about to be crazy. So there's Q1. You add up if you take these margins on these sales figures, you get this type of gross profit on these type of margins, which again, the math checks out cent for cent, 34.52% margins for a $252.8 million gross profit, which is what they reported in Q1 of 2025. So, what do you think? You think any of my assumptions are off? Would you change anything? And I'm excited to show you how does GameStop go from 34.5% to 29.1% quarter over quarter. And once we have that and we tease it out, right? We get some debate in the comments. You guys let us know what you think. All of a sudden we have a really healthy framework for distilling their Q3 numbers, which are reported in T minus 7 days, or T plus 7, maybe I should say. And we will have a very high level of clarity on the digital power packs portion of their revenue and the margins, therefore, that they're getting on the digital power packs in order to make sense of their total gross profit and margin percentages. All right, that's all I got for y'all today. I will see you in the next one.